All right, what do we have to know about the long-term financing cycle? The auditor knows that when a client needs to raise capital, they have two choices: equity financing, term debt. Most clients choose a mix of equity and debt. Why? Well, the auditor knows that debt is cheaper but riskier. Equity is more expensive but less risk. So a client that has a lot of debt capital, that's higher risk. It's cheaper, but if they don't make the interest payments, the company could be forced into bankruptcy. So debt is cheaper but riskier. Equity is more expensive on a percentage cost basis than debt, but less risk because dividends don't have to be paid the way interest does. When a client issues bonds, they have to pay interest. If they miss even one interest payment, they can be forced into bankruptcy by the bond holders. But once the client pays that interest, nothing else needs to be paid to the bondholders. The client keeps all the profits. Debt is risky, but with that risk comes the opportunity for big rewards. Why? Because once the client pays the interest, nothing else has to be paid to the bondholders. All the rest of the profits go to the owner. So if your client is a real desperado, a real gunslinger, they'll raise capital by issuing mostly debt. So let's talk about debt capital first, and then we'll go on to equity. From an auditor's perspective, debt capital involves a contract between the client and the bondholders. These bondholders are investors, and they're only looking to earn interest. Unless the bonds are convertible into shares of stock, the bondholders have only the right to interest payments on scheduled dates and the return of their principal. So the auditor knows that the bondholders are going to be looking for interest payments and the return of their principal. The client may have obligations beyond just paying interest and repaying principal. So the auditor needs to be familiar with what's called the bond indenture agreement, which is the contract that spells out all the client's obligations under this bond arrangement. Because remember, what's the client doing when they issue debt? They're borrowing cash. They're only issuing bonds for one reason. They need cash, and they have to repay the amount borrowed, called the principal, and they have to pay interest. So let's get a look at the bond indenture agreement, which is the contract between the issuing company, the company issuing the debt, and the bond holders. In the financing cycle, the auditor's client is going to be issuing bonds to these bondholders, and the auditor knows that there's going to be interest payments. The principal also has to be paid back. But what else might the bond indenture agreement obligate the client to do besides just paying interest and paying principal? Look out for debt covenants. Within the bond indenture agreement, there could be a debt covenant or two, and that would be a promise made by the client that they will maintain a ratio, maybe a debt to equity ratio of, let's say, 3-to-1. The entire time the bonds are outstanding, they're promising that they will maintain a debt to equity ratio of 3-to-1. And if they violate that agreement, if they violate that debt covenant and don't maintain that 3-to-1 debt to equity ratio, then they've breached the bond indenture agreement. And the penalty for that would be that the entire bond would be due and payable immediately. The company would be considered in default, even if all the interest payments were current, simply because they violated a debt covenant. So maybe the debt to equity ratio might be a debt covenant, or maybe the current ratio will be a debt covenant. Maybe the company's promising to maintain at least a 2-to-1 current ratio. What does that mean? It means $2 of current assets for every $1 of current liabilities. And they're promising to maintain that the entire time the bonds are outstanding. So if there are debt covenants, the auditor would be very interested in whether the client has violated any. Because if the client has violated any debt covenants, this would cause the company to be in default, we said. Even if all the interest payments were current, they would have to repay the bondholders in full, immediately, if demanded by the bondholders. So this bond indenture agreement is that contract between the parties. And so far we know that it may contain debt covenants. What else could be in the bond indenture agreement? Sinking fund requirements. There could be a covenant in the bond indenture agreement regarding sinking funds. If so, the client must contribute cash into a restricted bank account every month to help secure bond repayment to make sure the company doesn't run out of cash when it comes time to repay the bonds at maturity. So the bond indenture agreement usually requires the client to hire an independent financial institution as trustee. If so, the trustee has custody of the restricted cash, the bond sinking fund, and the auditor would want to confirm with the trustee that the client was protecting the bondholders by depositing the right amounts into the sinking fund and paying interest on time to the bondholders, and then confirm the year-end balance of the sinking fund, because that amount is going to be reported as restricted cash, a non-current asset on the balance sheet. So they could ask you questions about the bond indenture agreement on the CPA exam. Other items listed in the bond agreement, besides things like the issue date of the bonds, the maturity date of the bonds, the face amount of the bonds, which would be $1,000 times the number of bonds issued. The face amount of every bond is $1,000. So if they issued 100 bonds, then the total face amount of the bonds would be 100,000. If they issued 1,000 bonds, the total face amount of the bond issuance would be $1 million. You should know the basic journal entries in connection with a bond issuance. If the bonds are issued at par, you would debit cash $1 million, credit bonds payable $1 million, and that's a long-term liability. So the auditor needs to know the journal entries that the client should have made at the time the bonds are issued. And if the bonds are issued at par, it would be this entry here. If the bonds were issued at a discount below par, maybe the bonds were issued for $980,000 instead of $1 million, notice you would still credit bonds payable for par, the face amount. Cash will be debited for the amount that comes in, and the difference will be plugged to discount on bonds payable. If the bonds were issued at a premium, that means they would be issued above par, so that means the cash comes in is more than the amount that has to be paid back. Cash will be debited for $1,030,000. You'd still have to pay back the same $1 million. So you'd always credit bonds payable for face, and the difference here will be credited to premium on bonds payable, will be a credit for $30,000. Notice that bonds payable is credited for the $1 million regardless whether the bond issue was at par, face amount, below par at a discount, or above par at a premium. The bonds payable always credited initially for the full face amount. The bonds payable account is a long-term liability. The discount on bonds payable is a contra liability. The premium on bonds payable is not a contra liability but an adjunct account because it has the same balance as bonds payable, whereas the discount is a contra account because it has the opposite balance of bonds payable. So now back to the bond indenture. Whether the bonds are convertible into common stock or not would be in the bond indenture. So if the bondholders had the ability to convert their bonds into stock, that would be in the bond indenture agreement. And if they converted, that would be good for everybody because then the client wouldn't have to come up with the money to pay interest and principal anymore. And the bondholders, although they wouldn't be bondholders anymore, they would be stockholders having converted. And the theory is they would only be converting if it was a good time to convert, if the stock price was doing very well. If it was convertible bonds, the conversion ratio would be in the bond indenture. Maybe it takes 3 bonds to convert into 1 share of common stock. Or maybe 1 bond can be converted into 2 shares of common stock. It would all be in the bond indenture, whatever the conversion ratio is. What else would be in the bond indenture agreement? Provisions for retirement of the bonds, because both parties would want to know if the bonds can be called or redeemed early. What else might be in the bond indenture? Whether any assets of the client are secured as collateral for the bond. Sometimes the entity agrees to secure the bond issue to specific assets in the event of default. If so, this would be in the bond indenture. So for these reasons, in the long-term financing cycle of the audit, the auditor should examine any bond indenture to determine that the client is meeting these conditions of the contract. Some bonds may be maturing soon, and if so, that amount should be listed as current liability on the balance sheet, and that might mean reclassifying some of the long-term debt to short-term. So the auditor's got to be looking out for some of these bonds might be maturing within the next 12 months, and then the client would have to adjust the financial statements if they're carrying all these bonds as long-term and they have bonds maturing soon. Let's try this question. In the long-term financing cycle, the auditor would get familiar with the bond indenture agreement because it contains information about which of the following? Interest payment dates? Yes. Provisions for conversion of bonds to common stock? Sure. You think the auditor would want to know the interest payment dates of the bonds? Absolutely, because if the client missed one of those interest payment dates, they're in default. And of course, provisions for conversion of bonds to common stock, the conversion ratio would be in the bond indenture as well. So both of these are correct, letter C. All right, how about this? In the long-term financing cycle, the auditor would get familiar with the bond indenture agreement because it contains information about the existence of which of the following? A, debt covenants, sure. B, liabilities secured as collateral. Well, be careful. A is correct. The existence of any debt covenants would be included in the bond indenture agreement. But assets secured as collateral, not liabilities secured as collateral, would be included in the bond indenture agreement. And the auditor would want to know if there were any assets secured as collateral. Got to be careful not to read the question too fast. So the answer is A. All right, in the long-term financing cycle, the auditor has learned that the client has a bond outstanding which included a clause that required the client to maintain an acid test ratio of at least 1-to-1 at all times. That's the quick ratio, right? Just a few of the most liquid current assets divided by all the liabilities has to be 1-to-1 or better at all times. That means $1 of quick assets to $1 of current liabilities. Can't go below that. The auditor would learn about this from reading the auditor would learn about this debt covenant from reading the bond indenture agreement, right? The answer is D. This is a debt covenant where the auditor learns about this, the fact that they have to maintain an acid test ratio of at least 1-to-1 at all times. That's a debt covenant. And how would the auditor learn about that? From reading the bond indenture agreement. How about this one? Which of the following would be least important to an auditor in the audit of non-current debt? A, the stated rate of interest on the bonds. Now, the auditor would want to know that interest rate associated with the bonds, and that would be in the bond indenture. The existence of any debt covenants. That would be very important too. So don't pick A or B because we're looking for the least important in the audit of non-current debt. Sinking fund requirements. Remember what that is? That's where the company is obligated to sink money into a restricted cash account to protect the bondholders. That's important too. So A, B, and C would be very important because if there were sinking fund requirements, the auditor would want to know if the client is complying with those requirements. How about D? Verifying the existence of the bondholders. D is the answer because that would be the least important of the four to the auditor, verifying the existence of the bondholder. While they could do it, the possibility that the bondholders do not exist, that's not a significant risk. So we'll go with letter D. All right, what are some audit procedures relating to bonds payable? The auditor should review the minutes of the board of directors meetings. Why? For authorization of the bond issue. The amount issued should be no greater than the amount authorized in the minutes. So if the bond issuance was for $1 million, that's the amount that should have been authorized, and all you'd have to do as the auditor would look at the minutes of the board meeting. Reviewing the minutes for authorization is an audit procedure regarding long-term financing. In the long-term financing cycle, the auditor is concerned that some bonds payable may not have been recorded. The risk here is that the bonds payable balance may not be complete. So that's another issue. The fact that the client issued the bonds, maybe they were authorized, but they weren't recorded. So now we're missing liabilities from the balance sheet. What's a procedure to find that? An analytical procedure could be to compare interest expense reported on the income statement with bonds payable reported on the balance sheet. If interest expense seems excessively high, this may indicate unrecorded bonds payable. Why? Well, if interest expense on the income statement is $30,000 and bonds payable are only $100,000 on the balance sheet, this would indicate a 30% interest rate on the bonds, or it would indicate that some bonds are outstanding and have not been recorded. So by doing that analytical procedure, you would compare underreported long-term liabilities. If bonds payable were truly only $100,000, interest expense should be more like $5,000, not $30,000. All right, in the financing cycle, which of the following will be included in an audit plan for non-current debt? A says, comparing interest expense recorded for the period with outstanding debt. That sounds likely because that's an analytical procedure. We mentioned that comparing interest expense on the income statement with bonds payable on the balance sheet will give you the reasonableness of the long-term debt balance. So if you're in this cycle and you do this comparison, that would be in the audit plan if you want to make sure that bonds payable are not understated. B, comparing the carrying amount of held to maturity securities with its year-end market value. Well, what are held to maturity securities? They're only important if you're owning the bonds, if you're an investor. If these are marketable debt securities, you would classify them as either held to maturity or available for sale, right? So B is out because that's a different cycle. That's the investment cycle. This is the long-term debt cycle. C, investigating credits to the bond interest income account. Letter C would be an audit procedure if the client were the investor, the bond holder, but we're the bond issuer. So that wouldn't be an audit procedure in this cycle. So the answer would be letter A. In a financing cycle, comparing interest expense reported on the income statement with bonds payable on the balance sheet, that's an analytical procedure to test completeness of long-term payables. Because if interest expense seems excessively high, this might indicate unrecorded bonds payable. Let's try this one. All right, how about this? In the long-term financing cycle, the auditor would get familiar with the bond indenture agreement because it contains which of the following? 1, the names of the original bondholders. No, wouldn't be in the bond indenture agreement. There'd be a list of them somewhere, but it wouldn't be in the bond indenture agreement. 2, the company's debt to equity ratio at the time of issuance. Be careful because there would be possibly a debt covenant with regard to the debt to equity ratio, and it might say that the company has to maintain a certain debt to equity ratio at all times. But the current debt to equity ratio, the one at the time of issuance, wouldn't be in the bond indenture agreement. So 1 and 2 are out. 3, what will be in the bond indenture agreement? The issue date of the bonds and the maturity date of the bonds? Sure. 4, whether a trustee is involved in sinking fund transactions? Yes, that would be in the bond indenture agreement. So C is the answer. 3 and 4 are correct. See, a trustee might be involved in sinking fund transactions. The company might have to hire an independent trustee to protect the bondholders. Maybe the bondholders don't believe that the company is actually going to put that money into the sinking fund, so the client agrees to hire a trustee to oversee the sinking fund, the restricted cash. So if the trustee maintains custody of the sinking fund or restricted cash account, the auditor would need to confirm with the trustee what the balance in the sinking fund is at year end and what transactions occurred during the year regarding the sinking fund. So 3 and 4 are correct. 1 and 2, no. The company's debt to equity ratio at the time of issuance is not included. But what would be included, we said, was any restrictions on that ratio. Like if it must not exceed 2 to 1 for the entire time the bonds are outstanding, that would be included in the bond indenture agreement. What would 2 to 1 refer to? $2 of debt for every $1 of equity. The company would not be able to exceed that the entire time the bonds are outstanding. And if they did exceed it, remember what would happen? They would be considered in default, even if they were current with the interest payments. And then what about number 1 here, the names of the original bondholders? Would that be in the bond indenture agreement? No, but there is a list of original bondholders, but their names would not be included in the bond indenture because this bond indenture is a long-term contract, and these bondholders, they could turn over. Just because you're an original bondholder doesn't mean you're going to have the bonds for the whole 10-year term. So what would be in the bond indenture would be something that would be a right or an obligation for the entire time the bonds are outstanding. How about this one? In the long-term financing cycle, during the audit of a client who has bonds outstanding, The auditor should obtain written confirmation regarding bond transactions from who would be the one that the auditor would obtain written confirmations regarding bond transactions from? Not the client's attorney, not the internal auditors, but the trustee. Neither the client's attorney nor the internal auditors would have the independent information needed to confirm the bond transactions at year end. So the best answer here would be the trustee, because if the client had to hire the independent financial institution as the trustee, then the trustee would have custody of this restricted cash, and then the auditor would go after the trustee for confirmation of the transactions and the balances. The auditor would confirm with the trustee that money was deposited into the sinking fund during the year, that the interest payments were made on time, and the balance in the sinking fund at year end would be confirmed with the trustee.